All right, we'll be getting going in about 3 minutes. I changed a few of my settings to get this to work, so hopefully there aren't any weird technical difficulties from here on out, but hopefully we'll get everything going smoothly and get up and going in 2.5 minutes from now. If you are tuned in and watching, feel free to throw something in the chat so we can hear from you. But until then, we're going to hang tight and hopefully get some more people in here. All right, we got Luke on YouTube checking in. Appreciate that. Always love to see people popping in the chat. We got 15 more seconds. 10 more seconds. And we are ready to go. JWP in the Twitch chat. We got you checking in. Welcome. And thank you for bearing with me during our brief 2-3 minute technical difficulties that we had at the beginning of the stream right here when we were trying to get it up and going. But hopefully it's up and working now, and you guys can both see the video clearly and hear me clearly. So we are going to jump into a quick recap. We're aiming for just under an hour tonight. I got to be done by 10 o'clock Eastern, so we'll try to pack as much into here as we can and not just, drone on about the recap. But the good news in that regard is there's really not a lot to recap, right? We've had this same UWMC position going for a while. Let me zoom in really quickly so you guys can see it a little bit better. I've got this big monitor, and sometimes what looks big on my screen probably isn't as big on your screen. But this UWMC play we're still sitting on, as you can see down here, as long as it stays above 8 by June 18th, we're going to pull another 360 bucks off that. So we are perfectly happy to keep that one just as is. We've got Icln, another very boring play. You could ignore that. I mean, overall, we had a really good week, but when you get to the fourth row here on this recap table, you could see what happened. And it's that PSTH took a huge dip after they announced their target. So to briefly talk about that, we sold 25.5 strike calls. We got really nice premiums on that. The second PSTH dropped, we rolled down to 23.5. Got more good premiums on that because of the volatility of the stock. Obviously, we had to go 2 strikes lower to collect a little bit more, but all in all, we're able to collect 885. So, while it does suck to lose 4,500 from your stock in 1 week, that $885 cushion makes it a little bit better. And as I've, built out over here, our break-even price is now 23.01. It's trading at 22.06. So overall in the trade, we're still at like a $2,000 loss for now. But if this thing pops back up to 23.5, guess what? We have a 10% return in just over a week. So that's how quickly plays like this can turn around. We started playing this just under $25 a share. So the fact that we're able to absorb as big of a drop here as we have, and I think we said what 2301 was the break-even price. The fact that we're able to absorb a 7.11% drop without losing any money, just a really solid testament to the strategy and why I'm perfectly happy continuing to hold this moving forward. So I don't think that one's going to be an issue. It might just take another week or two to resolve that play, a little bit longer than we initially expected, but that's all right. LOTZ was a great one for us. We played this one to bounce back up to $5, and it's already back above 5. We're hoping it holds above $5 a share because, as you could see, if LOTZ expires at 5.11, these will be worth 11. So if LOTZ finishes above $5 on June 18th, we're going to pull another 1.1K off that position. So again, that's one we're perfectly happy to continue holding. Zillow is one we've been going back to the well a bunch on because we think that one is at a great price point. There's also some decent option premium on that, in addition to it being a stock where we're able to use some of our margin privileges. So we really like that one. We pulled a modest profit off that. And of course, our SPX hedge, which is on an insane winning streak when you keep going back up 2 weeks in a row, 3 weeks in a row, 4 weeks in a row. In fact, let me just to show you how effective, even though this is a hedge, the amount of money we've been getting off this: 3 weeks in a row, 4 weeks in a row, 5 weeks in a row, 6 weeks in a row. This is probably getting a little bit repetitive. 7 weeks in a row, and then we finally had a loser back in beginning of April. But we've made money 7 weeks in a row off our SPX hedges, and we've gotten $16,000 of profit off of them. So we have done awesome with those, and we are perfectly happy to keep those going because even though they are a hedge, it's funny sometimes when you're able to find good value like that and good premiums and the market relaxes a little bit. They can turn from a hedge into a pretty damn profitable position, as we have just shown. But that is a very quick high-level recap of what went on last week. Some of these other plays we were looking at did turn out decently. This earnings play with APPS would have hit max profit. The SPLK earnings play would hit max profit. And the DocuSign earnings play would have hit max profit as well. So we're definitely going to be looking into more earnings plays. I think then, again, this is what we've rolled forward into the following week. It's really all just the same. We rolled Zillow, same strike 1 week later to get $1.83 a premium. We're in a position to collect, about $1,500 off that should Zillow stay relatively flat from here on out. So this is what we've got. We pretty much covered everything that's in this table with what we just said for our previous week recap. So let's get into some new, fresh trade ideas for the week and not let this stream get too dragged down with recap and stuff that we've probably already beat the dead horse on, so to speak. So we're going to instantly jump over into Thinkorswim, our favorite trading software. We can see futures are down 0.14% right there, which bodes well for that SPX hedge that we've got in play. But looking forward, we like this Zillow play. And let me talk more about Zillow really quickly. The way that I want to break this down, and going back to our strategy summary page to show you how effective our different strategies are, right? We have our basic H2 wheel strategy, and then we have pretty much 4 variations of more advanced option strategies that we use in conjunction with earnings. So we've used naked strangles with earnings. We've used iron condors with earnings. We have, just a general earnings category, which is what we refer to when we sell cash secured puts during earnings. And then our 10-day play. And all of these have had really solid success rates with really nice average returns. So we're going to look to keep doing this. As you can see right now, the amount of plays that we have is pretty low compared to what we historically hold on a week-to-week basis, right? We'll fill up the whole page with our plays sometimes, but right now we've got a pretty short list, which means we have a lot of buying power ready, and we are anxiously awaiting a dip in the market so we could go ahead and use that buying power. So we are finally now going to take a little bit of a look at what we are looking to use that buying power on, which leads me into the first discussion, and I guess a little bit of an overview about how we're going to categorize plays, right? So I have this set up as a watch list. The first thing we're going to have is we're going to look for plays that fit our typical H2 wheel strategy, right? And that's the most common strategy that we use. We've used it 54 times with just under a 90% win rate. These plays last on average about 3.5 weeks, and that's dragged upwards by a couple big time outliers. But in general, really, really solid play, and is the basis of how we've derived all of our profits. The next is we're going to look at 10-day plays, which we'll explain those when we get to them. But they are based off earnings, but you're not playing at the earnings week. And then the thing after that we're going to look at are, just earnings plays, because we love to sell options, and the best time to sell options is when you identify a stock where the option chain has inflated premium. There's no better time to sell inflated premium than during earnings. So that is why we are going to look to earnings as we patiently wait for a dip in the market, and that's when we're going to open up and sell to open a lot of our HT wheel positions. But in the meantime, we're sitting on all this buying power. We're patiently waiting for a pullback in the market. What can we do with that capital that we have on the sidelines to be more efficient? And to me, playing earnings is a great way to do that, because sometimes I get a little bit bored if I'm sitting on too much cash at one time. And that's not to say that that's not a good thing, because holding cash is also a position, and a position you would love to have every time the market takes a 1 or 2% dip during the day. So we're perfectly happy to have that buying power on the sidelines. But as you'll see, and hopefully we can explain a little bit later on in the stream, when we get into these earnings plays, we almost are able to put ourselves in a position where our cushions are so big on either side that our results are really irrespective of overall market performance. And I think that's a great way to kind of keep a little bit of capital tied up, have something to be paying attention to during the week for a little bit of excitement and some potential returns as you await to leg into some of our more consistent plays. And we've got Jules checking in the YouTube chat. How is it going, Jules? We got more for in the Twitch chat. Wants to look at SNDL and MSTR. More for, we've always got time to look at the stocks that you want to take a look at. We've got Dashio in the Twitch chat also. Appreciate you tuning in every single week, you guys. Love having you on here, and hopefully you guys have loved being on here, because I think we've been doing decently well lately. Yeah, I know the two performance related sells you can see here are both losses, but if you take a look at our year-to-date summary, we have this quick loss in June just related from these last 2 weeks. But overall, we've still got 3 weeks to come back from that. We could do so pretty easily, but we haven't lost money a single week so far. And hopefully you guys have had some similar success. We talk all the time about how we have this chart where, maybe we've been moving up and down a little bit too sharply, and are trying to aim for some more conservative strategies and conservative stocks, while still giving us some similar upside potential to smooth this curve out a bit. But that's not to say we haven't had a great year so far. So we're going to jump into it and hopefully keep it rolling. And I know maybe 5 minutes ago I said that I was super excited to just get jumping into the stock analysis, and then went to ramble on for another 5 minutes. But now we are finally going to get into the stock analysis, and we're going to kick it off with Zillow, which closed at 108.80 Friday afternoon. So what we've done here, as you can see from the red position flag, excuse me, we've sold 107 strike puts. And if you go back to our profit tracker, that's literally us just rolling our position from last week. We closed it out for a profit and then rolled it into this week, where we're going to be able, presumably, to collect a lot more premium. And as we know from, when we sell cash secured puts, we have a 107 strike on here. So if Zillow finishes above $107 this week, we're going to hit max profit of roughly $1,500 on that. But the best part, as always, is our downside protection. So 107 minus the premium of 183 means that our break-even price on this trade is going to be 105.17. And if we take a look at the chart here, and for those of you who also watched last week, tonight are going to be loading a little bit more quickly than they were last week. But here we go. So 105.17, I think I said. Yeah, 105.17 is going to be our break price, and we've got to zoom out to get to it, which is always a great thing when we're trying to look at cushions. So we're going to draw this big red line on here to indicate 105.13, close enough, 16 is our break-even price. And as you can see, we really like that cushion, because over the past 5 years, Zillow had a decently sharp drop, which allowed it to fall back into this range that we're comfortable with investing in it at. And at the same time, if we back up a little bit further, there's some decent resistance. We're going to right-click this, extend it to the left so we can see. The last 2 times it got down to this level, it bounced off pretty quickly. So we think at least over the short term, meaning in the next 5 days, we should be able to have some decent cushion and decent support at this level, to where I think this is going to be a really nice play and decently profitable for us. Now, if you back up On the longer term, you could actually see this level of support again back in late November, early December of 2020. And that's one of those things that makes me even more confident in this strike that we've selected. Now, if you want to get a little bit more conservative, there's also another great opportunity, and we have actually done this as well. I don't think I actually called it out in our chat or put it, which is why it's not in my profit tracker. But the 100 strike puts actually provide another really nice opportunity. Surprisingly, you could get about $1.20, $1.30 of premium on these, meaning your break-even price would be 98.9. And hell, we could draw that on here as well if I could. Close enough again. Right click, extend to the left. So, the only difference here, right, is your expiration date. But for having to wait another week, you now have a max profit point that's $7 or basically 7% lower than what we currently have for this week. We've right now. This is our short-term play. This is our, quote-unquote long-term play, even though it's only going to be one extra week. But as far as a stock like this, with the amount of premium it's offering 2 weeks out, this is a really nice opportunity because, as we alluded to a little bit earlier, Zillow is one of those stocks where you get some more relaxed margin buying power requirements. So if you wanted to sell one of these, right, and we know that $1.20 a premium means that if it finishes above 100, you're getting $120 in profit. So if you sell one of these, you stand to make $120 in profit and only tie up about $1,200 in buying power, which is a 10% return on capital. So, a 10% return in 2 weeks is phenomenal. Make no mistake about it. And the fact that you can get that 10% return in 2 weeks with this break-even price, this bottom red line right here, I think is a phenomenal value proposition, considering that Zillow hasn't traded at that max profit point since November 4th, 2020. And it would take a lot, I think, to break through this 105 price level. And even if it does in the short term, I expect we see something like what we saw back in November, where it broke through initially, but then bounced off that second level of support, which is at 100. So we talk about support and resistance so much. Not only is there one level of support here at 105, there's another level of support right around 100. So if you're taking this a little bit more conservative play, and while we do say conservative, the fact that you could still pull 10% return on capital is outstanding. You've got a lot working for you. We also like to look at RSI, the relative strength index. It's down at 36, which indicates that the stock is relatively oversold, and we can expect a bounce in the short term to see how effective RSI is, right? Historically, when it's gotten around this level, it happened, May 11th? And on May 11th, it went from 105 up to about 115. So we know RSI works decently well as a short-term price predictor. We could look back at May 4th when it went from 120 and bounced back up to 127. It got back low again at the end of March, where it bounced off of 120 all the way back up to 145. But long story short, you've got one, a really nice return on capital percentage. Two, you have two levels of support here. And three, RSI is indicating in the short term that Zillow has been oversold, so you can expect a short-term bounce. And that is why we love this play so much. We've been going to the low week after week at this price level. I think our plan is to continue playing it either until it keeps dropping down and we have to manage it, or until it breaks back above 120. But I really like the company. We've talked before about what they're doing in the long term, taking the whole real estate business digital, which is quite the macro view for a 2-week play right here. But I guess I'll close the loop with that, where I think the 105 for the current week, or the 107 for the current week, or the 100 for the next week, June 18th expiry, are some really nice values. And I'm going to take a quick sip of my water before we jump into our next one. All right. So we got a couple quick suggestions. More for in the Twitch chat wants us to take a look at SNDL, which a lot of you guys know is Sunday, is a weed stock, which during, I guess, our reincarnation of meme madness over the past week or two, I've seen a pretty big spike from 72 up to, it got to 150 after hours on June 3rd before falling back to about 130. And as you can see, it's since simmered down a little bit back to 110. But again, despite it falling back off, and again, we look at RSI, it's relatively oversold, so we can maybe expect a short-term bounce. But the question is, how can you use option selling and option selling strategies to position yourself in such a way where, if it does drop back down to 0.7, you're still going to be okay and have a little bit of a cushion that you're dealing with. So in order to answer that question, we're going to take a quick look over at, as you can see, weekly options, which is something we always really like to see. Big time ROR, especially for a 1 week play. And I really don't hate the idea of potentially selling, one strike puts. Now, granted, it's going to take a lot of these to make a decent, return from a dollar's perspective, but from a percentage perspective, an 8.11% return is not too bad at all. And here's the other thing you have to consider, right? It's really two parts, because when we sell a cash secured put at 1, we know that 1 minus the premium of 0.07 equals 0.93, meaning your break-even price is going to be right here for the first week. Let's draw that line on there at 93 cents. Oops, I did a terrible job of drawing the line. I got to click again. There we go. So we know our break-even price is right there. We're going to right-click this, extend it. I missed the line. Come on. Extend it to the left and zoom out a little bit. So over the month, this break-even price is well above, where it's been trading since the beginning of May. We could back up a little bit further on the 180 day, and you'll see the scope of what's been going on in 2021. It's not the worst break-even price in the world to have. And not only is it not that bad of a break-even price, you have to consider the second part of this play, right? So it's pretty much a binary situation when you are looking at options like this. So either it stays above $1 and you finish with max profit and you never need to look at this again. You're going to take your 8% return in a week and just run away. Or it finishes, between 0.93 and 0.1, where you're going to have a small profit and you could either close out, which I would recommend, or, keep it rolling. But if it finishes below 0.9, what happens is you get assigned shares. But you could have bought shares today at 109, on Friday at 109. But the great part about selling one strike puts for 7 cents a premium is instead of getting shares at 109, your shares are now down at this adjusted basis of 0.93. So part 2 of this play is what happens when you have those shares with a 93-cent basis. What can you do? So a drop from 110, and even if we look at this peak of 150 down to 110, and what would be a further drop down to, 90 or below in the next 5 days, would necessitate a lot of implied volatility, which pumps premium into the options. So going forward, even though you'd have these shares with a 93-cent basis, you could maybe count on there to be a decent bit of premium left in these calls, so you could keep chipping away at that basis week after week after week. So I really love the idea of going in off the bat with the one strike put. You'd have a 93-cent break-even price, and like we said, if it stays above $1, this thing keeps running, you're taking home an 8% return in 1 week, which is a phenomenal number. So I honestly might look to get in on this play myself. Let's take a look at margin requirements, right? We know if we were going to sell one of these contracts, it would take $100 of collateral. And if we take a look at the buying power, yep, that's about right. Your broker does require that these are fully cash secured, but hey, that's okay, because if, even though these are relatively smaller numbers, if you wanted to sell 50 of these, you could get $350 at max profit. It takes up about, 4.5K of buying power, but you'd have them at a 93-cent basis, and that's still an 8.11% weekly return, which is, I cannot emphasize enough how great of a number that is. And then, if it does drop on you, there should be a little bit of juice left in these calls that you could count on. And that's just something that happens when you see a big spike like we've seen over the past trading month. That volatility is probably going to last for another week or two, so I think we can count on that being there. So while I do caution against Sundial, because a lot of people say, hey, this is a weed stock, this is great, the United States is legalizing weed. What a lot of people don't realize is that this stock doesn't actually have a foothold in United States marijuana markets. So, if you're basing your investment thesis off, it's going to get legalized in the U.S., their business is going to explode, that's a little bit flawed. If you're basing your investment or, maybe short squeeze thesis off, hey, marijuana is getting legalized in the U.S., people are going to see that this is a marijuana name, it's going to go up, you might not be wrong there. But, for now, it's always you need to have that downside number in your head, because look, uh, less than a month ago, this thing was trading at 65 cents. So if, shit hits the fan, it goes back down to 65 cents. You need to be prepared for that. And I think the best way to be prepared for that is by starting off with a relatively modest position here with a 93-cent break-even price, and then taking assignment of the shares, covered calls week after week after week, until eventually it goes back above 1, or your basis is down in the 70 or 60-cent range, which shouldn't take too long in my opinion. So honestly, I will give that suggestion more for a seal of approval. So thank you for throwing that one in the chat. MSTR was the other one he wanted us to take, and that's micro strategy. Incredibly volatile, as we can see looking at the 1-month trading chart back on May 7th, 631. Bottomed out at 408 and is now at 485. Let's take a little bit bigger of a look here and talk about a trading range. I mean, 180 days ago it was at 144, peaked at 1315. I know exactly what they do, so we're going to take a peek at MSTR, provider of enterprise software platforms around the world. So I guess just a cloud-based subscription and services, just an information technology company. More for if you've got any info in particular about this company or any reason that it came to mind for you to suggest, feel free to throw it in there. But you take a look at a chart. It's a crypto name, says Dashio. Interesting. Well, that would quite honestly scare the hell out of me. Let's take a look at, the 3-year chart. Anytime we see a chart like this, it typically scares us. Yeah, more force confirming that in the Twitch chat. Bitcoin ownership is on their books. It's followed the path of the bubble. Based off how things like this typically turn out, I would expect it to maybe get down to this low 300, 350 level, back where there's a little bit of a bump at the end of 2020. But, seeing something that's gone from 9, 13, 15 down to 44, that is going to create some really nice premium in the options right here that we could look at. I just have trouble saying that kind of premium is worth it. I guess we could see how far out of the money can we go and still get some money. These are weekly calls. We can get a 1% return on 440s, which even if we sold one of these might be a little bit out of some people's price range, because it would take 40 grand of buying power, but it looks like it only takes 14K. So there's about a 33% maintenance requirement on those, meaning that if we look at the ROC, return on capital, it's probably going to be about 3%. Oh, they always do this as if it's 10% margin requirement. But the ROC really is about 3%, and that's still not that far out of the money for a stock that's moved like this. So as far as the premium that it's offering, combined with this insane range, the nature of the industry it's in with crypto, this is one personally I would stay away from, at least in the context of our strategy. So continuing forward, maybe talking about a couple that might be a good idea for our strategy. Let's our scanner, where we're going to pull up some high volatility names and names that, let's see, where's ROR? Names that have high volatility, do not have any earnings, and are in the S&P 500, so you could trust that there may be some more solid names. BIIB is one that comes to the top of the list. I think that's a healthcare. Biogen. Yep. The name of the industry. Care. Some serious volatility is expected in this one, because you could go how far out of the money here. You could get $1 of premium at 190, which is all the way. Well, I shouldn't say all the way, because actually, yeah, all the way down here, 190. This is a price Biogen hasn't traded at in the last 3 years. We're looking at the 3-year chart here, and you could get weekly premium on that. Let's see what the 3-year low is. 215 for Biogen, and at 215 you could get a 3% weekly return, which I don't know what kind of margin requirements they're holding on to right here, but you could get a 25% return. More than that. What's 590 just to sell one of these? Give me 1 second. I'm trying to pull up my calculator, and I'm doing a terrible job of typing calc. Here we go. You can get a 590 return, as you can see right here, off of $2,100 in buying power. So 2150, meaning you can get a 27% weekly return by selling cash secured puts for Biogen at a price that they haven't been at in 3 years, and that is insane. I mean, if anything, it might be one that's just fun to throw a little bit of money on because it has the risk profile of a spread while still being a cash secured put. But we know this is healthcare. This is something I typically try to stay very far away from because, as you can see from these incredibly large red candles throughout the 3-year history of this stock, healthcare is incredibly volatile, and I think they have some pretty big news on the horizon. There we go. So ahead of Judgment Day, FDA faces test with Biogen's Alzheimer drug decision. They have a Monday deadline to decide on their Alzheimer drug, and I imagine that is a pretty big drug for Biogen. If they're anticipating that if it doesn't get approved, it's going to drop down in here. But if this is still trading on Monday and they make their decision after hours, it might be a fun one to take a little bit of a gamble on. So that's one I might keep an eye on, take a little bit of a flyer. But in general, just know that any time you use our strategy in the healthcare market, especially when you're waiting on a binary event like an FDA decision, you're playing with fire a little bit. And something I would just hope that you understand is it's pretty much gambling at that point. So I would not recommend it as the core part of our strategy, where we try to be smart with what we're doing. So maybe stay away from that one. If you're super bored, go crazy, sell something super far out of the money, and as long as it doesn't drop 50%, you're going to be looking decently fine, which is funny to think about. Moving on back to our scan though, we've got Tesla, GPS, KO, FCX is a copper name that we've looked at lately. And we've been saying that we want to wait for a drop down into the 30-35 range. We're patiently waiting for that. In the last 10 days, looks like on June 1st, which was, I couldn't tell you what day of the week that was. Tuesday? Maybe Tuesday. It dropped down from 44 and ended the week at 41. We like this because it's a commodity. There are inflation fears, so it's always good to have a little bit of your portfolio tied up in commodities because inflation relatively equally affects commodities. So if you're worried about stock devaluation due to inflation, commodities are a good hedge against that. Additionally, really nice margin requirements, if I recall correctly, whereas normally to sell a 40 strike put fully cash secured, it would take $4,000. This only requires 662, meaning you get a $41 return on $662, which is, there we go, 6.2% return on capital, which is a really nice number for the week. But again, that puts your break even right here, which is a price that it hasn't traded below in the past 5 days. But if and your break even still below where it's traded in the last month, so maybe not the worst idea. But what scares me is if we zoom out again to the 180-day chart and see that it was $14 180 days ago, $41.73 now. One of those things where if it really does decide to drop, I think this is one that I would not want to be in on the ride back from 40 to what I think should level out in the 25 to 30 range. So I'm going to patiently wait for that drop. And if it does get down near this 35 number, that's when I think I'll be jumping in on this one. And if it doesn't get down to the 35 number, no big deal. It's so much better to miss out on a good trade than to be stuck in a bad trade. And with setups like this, I think you could maybe find yourself in a bad trade. We've got Westwind Winter checking into the Twitch chat, fact checking, helping bring some value to the stream. So we love what you're checking in with, saying Biogen has had numerous job postings within the last week looking for Alzheimer account liaisons. They are non-research positions with the primary role of establishing access, engaging with healthcare systems, sites of care, and healthcare professionals involved in neurology and Alzheimer's disease care, and to understand the challenges and identified, integrated, blah, blah, blah. Basically, they're looking for employees, which would be necessary if this drug is approved. So, speculating that you might see positive news, potential counterpoint that pops into my mind is, these are just postings, and they could probably go through interviews now, know who they need lined up. But, if tomorrow afternoon the FDA says, this isn't going to be approved, they can just throw those out the window. So while that is, it's good that maybe they wouldn't be having interviews at all or looking at all if they were expecting bad news. I think, maybe a posting isn't necessarily as final of a piece of evidence as I would like to look for something like this, where you're trying to guess the results from an FDA decision. But sometimes it's better than nothing. I don't really know what else you would use to speculate. So really interesting piece of information. Appreciate you throwing that in there. And it is, I hate going in on healthcare stocks with cash secured puts, because you could be left holding a pretty big bag. But with the lower margin maintenance requirements, I need to probably admittedly do a little bit more research about how much of their revenue they derive from this Alzheimer drug, because, look, we saw the 3-year chart, right? It looks insane. The fact that you could get premium for puts right here is fantastic. It's a price that hasn't traded below in 3 years. But, do they rely so heavily upon this potential Alzheimer drug revenue that, if it gets shot, they're going to be going down to 150, and then I'd be holding a pretty big bag. Let me take a little bit look at a longer time frame. We can go 10 years here. Yeah, so the last time it traded below 215 was in 2013. I mean, I don't really know what to make of this, other than the fact that they must have a huge amount of money potentially tied up in this. Let me really quickly, so I don't just ramble on about something I don't entirely know about here on the stream, I'm going to see if I could open up maybe one of these news articles to see if we can get the answers that we're looking for here. So pivotal moment. Maybe this will give us a little bit of the information that we're looking for. It'll be the first new Alzheimer's treatment in more than 2 decades. Experts have questioned how well it works. It's going to be approved sometime, potentially approved on or before Monday. It'll be the first new drug in more than 2 decades, like we already said. Some of these articles can get a little bit repetitive. So it looks like people are modeling a 70% chance of approval. Interesting. In early 2019, they shared disappointing clinical results from 2 phase 3 clinical trials, and said it would scrap development of the drug as a result. Oh, so this is a drug that they already said that they were going to scrap and give up on, and then I guess they reinterpreted the data to put it back into trials. Okay, so here's some really interesting, some news right here, right? So we talk about this 215 price point. This is exactly what I was looking for, so I'm glad this came up in the article. As it said, the stock hit a 3-year low of 216.71 when the company said it would stop developing this drug. So here's the deal. If the company stops developing this drug, 216 looks like it might be the floor again. This might be okay. It didn't get approved. So we're going to go back to the same set of facts that we had back in 2019, where when we knew that it wasn't approved, it went to 216. After reading that, I really like the potential of this play. We've got people saying an approval could send the stock as high as 390, which, hell, if it goes to 390, awesome. I think my 215 puts would be perfectly safe. But they're also saying a decision against it could see it drop to as low as 200. So not below 200, as low as, implying this is the worst case scenario. So worst case scenario, as we sell these 215 strike puts, oh man, I think I'm going to do this. These have a 200, we'd get $6 and something for these. And I'll tell you what, it might almost be a better deal to go after the 210 or 205 just for a slightly lower break-even price with that $200 share downside. And like you're saying, Dashio, in the Twitch chat, exactly. I think this is one where It is 100% a gamble, but I don't think it's that bad of a gamble. Because one, that article also modeled in, or excuse me, the article said people were expecting 70% chance of approval, which, likely, which would send it up. We would love to see that. But even if it didn't, all we would have to do is last until Friday above 215. I am going to do this play. I think I'm going to sell a couple of these. Admittedly, it is absolutely a gamble, and I may be stuck with this healthcare stock that I want nothing to do with. But here's the deal. As we mentioned, similarly with Sundial Growers, SNDL, even if it does drop to 200, I would imagine that the IV for the next week is pretty crazy. So we'd be able to sell some calls for a decent amount of premium to get our break even right around 200 overall in, 5 days time. This is a play that I'm going to do. I'm going to throw this on my watch list. I really like what we see right here. BIIB, that's under the typical HT wheel strategy. Hopefully the FDA waits until after market on Monday to announce, because I would be devastated to wake up Monday morning seeing that it's been approved and we got to miss out on it. And before you read a little bit too much into that statement, I would not be devastated to see that an Alzheimer drug was approved. So I think it would be objectively great news. I think sometimes it's funny with stuff like this. A little bit of perspective could help, but would love to be on board and have it be approved, double win right there. I think we would love that as well. So, Monday morning we'll wake up, we'll see where it's at, and we'll keep it going. It's looking like Dashia says the expected move, as you can see right here, is $70. So we love to use this expected move. We use it a lot with our earnings plays because selling, I guess the simplest way to explain it is you make money selling options when historical volatility is lower than implied volatility, since the premium you derive from the options you sell is based off implied volatility. And typically historical volatility does come in below implied volatility. So this gives you, the implied volatility, the plus or minus $70 move. 70 knocks it right down to 216.14. I am a huge fan of this play. I'm going to jump in on it. We're not going to talk about it anymore because we got about less than 15 minutes to wrap up the rest of this stream. So let's talk quickly about some earnings that we've got coming up this week. There are two in particular that I wanted to highlight. Let me drag the old Discord server onto the screen so we can take a look at that. And hopefully it'll load so you guys can actually take a look at it with me. But uh-oh, baby is out, says Jules. That is a lot more intense than what I am doing tonight in the corner of my bedroom. So good for you, Jules. Earnings plays. Here's the calendar that we're going to pull up. There really aren't that many big-time earnings names that are being reported this week. Well, we've got GameStop on Wednesday. We're just not even going to touch that. But then the other thing that's going on this week is Stitch Fix on Monday after close and Chewy Thursday after close. And I wanted to touch on Stitch Fix momentarily because I think someone threw in here that Stitch Fix had a 15% anticipated move right there. That's IHW, who has been a great contributor to our Discord service. Let me throw SFIX in there. There we go. We've got weekly options on this. An $8.61 implied move, which we know on the upside quickly. 55.52 plus 8.61 means 64.13 on the upside. Let me go back to, I think the 20 days probably, that 180 days probably the best way to look at this. So what we're trying to do with this, when we see a stock that has a really big implied move coming up, as Stitch Fix has, which is 861, which is an implied move of what, 8.61 divided by 55.52 is a 15.5% implied move. So what we try to do is set up a strangle, meaning we want the stock to stay in between two prices. Normally we'll sell a cash secured put and say, hey, we want the stock to stay above this price. But with the strangle, we try to peg it in between two prices. So with the 55.52 closing price on Friday and an 861 expected move, that means the upward range of the expected move is going to be $64.13. So let me throw that on there with our drawing, 64.13. Come on. It's a little harder. Close. Let's extend that out to the left. And then the lower range of our trade is going to be 55.52. What was that expected move? 8.61. 55.52 minus 8.62, giving you 46.9 on the downside. So we'll right there, 46.2. So while I guess from a maybe mathematical, more mechanical approach, you'd say, I'm going to set this here. I'm going to set this here. I'm just going to let it ride and let the numbers go to work. But what we like to do is we are going to take a little bit of a different approach here. And I'm going to get to that in 1 second. But first, I'm going to answer Jiggy Snipes' question. He said, wouldn't there be IV crush after the FDA decision? So wouldn't next week's calls be worth less? And you are 100% correct. However, right now, the IV on Biogen is just completely out of control, right? If you look at something that is right at the money on Biogen, you are looking at $32 of weekly premium, which is insane. That premium is not going to be there on a week-to-week basis after the FDA decision. However, it's the two-part play, right? If it goes up, we're not going to have to worry about this stock ever again. Hopefully Alzheimer's is cured and our bank accounts are cured as well. But if it goes down, obviously, like I mentioned, you're not going to be getting $32 to $37 of premium right at the money. But with our break-even price being at $210, we don't need $32. I mean, the premium on this can be cut in a third, and what would be a roughly 20% drop on something like this? Is that right? 286 times 0.8. What would be greater? 286 times 0.7. Yeah, so what would be a 30% drop in 1 week? Typically, you'd see some inflated premium in the short term because people are expecting a bounce off the bottom at some point. And add that to the fact that we've got a decent range of long-term support at 215. I think that's a really nice combo for a 1-2 play for this week and next week. So that is why, I guess that's the implied volatility that I'm mentioning. The implied volatility that results from a 30% drop in 1 week as opposed to implied volatility from, a big-time FDA decision. Like I mentioned, this is big-time FDA decision IV. It's way higher than what we're going to see in the coming weeks, but, we don't need $32 of premium a week. We only need roughly, maybe 4, 5, 6, 7 to get ourselves down to a respectable break-even price. But back to SFIX. So again, if we were going to take the mathematical approach with our strangle here, we say, hey, we're going to keep it below 64.26. We're going to keep it above 46.27 and hope that 5 days from now it stays within that range. However, we can use that mathematical approach, let the numbers go to work, and typically, that's going to work for you. But we could do one better by using, ideas behind support and resistance to help ourselves a little bit better. So what we could see right here is that, it bottomed out at roughly 67.68, bottomed out at, 67.68. There was a little bit of chop right in there. That might be a little bit better point of support at 67 than what we're seeing right here at 64. So we would want to bump it up to 67 for the call strike on our, give me 1 second, 67. I'm not going to hit it. Close enough. So we'd bump our call strike up to 67 on the strangle. And what we're looking at right here on the downside, not too bad. It looks like it lines up with the peak here. It lines up with where it dropped back in the end of March. There should be a level of support right above it from what we saw at the beginning of March. And it's at the top of a big candle from back in December. So presumably that might be a decent level of support. But let's go to the option chain, right? We know that we're going to want 67 on the call side and we're going to want 46 on the put side. So let's go take a look. We're going to switch the spread to strangle. And you can click whatever you want. It doesn't matter. But on the call side, we're going to want, what did we say, 67? There is no 67. It's 65 or 70. So we'll call it 65. And then on the put side, we're going to want 44, I believe, is what we had. And there is a 44 that we could select. So what you have right here now is a 65, which is going to be right here again at the original spot. 65 and 46, we dropped it down to 44 though to get a little bit below that. 65, 44 strangle for a 281 credit. And what we know about the credits we get is that means that we get that much of a cushion on the outside of both of these. So really our break-even price on the upside is going to be 67.81, which is coincidentally pretty much right here, which is where we wanted that in the first place. And then our break-even on the downside is going to be 44 minus 2.81, which is going to be 41.19, I think. So that'll put you right here, which coincidentally is a peak back in, early December. So hopefully something that would act as a little bit more of a area of support, especially in the short term. Out, we've seen some big earnings moves from Fix, so nothing out of the question, but something where, I would hope that the amount of premium and the amount of cushion we've given ourselves here could turn out to be a pretty high percentage play. And now we can take a look at, it requires $1,200 of collateral. Here we go right here. It requires, you can get a $281 return off the $281 of premium, and it requires $1,274 of collateral, meaning this is a play that'll give you a 22% return on capital. And we've set this up using the idea of implied moves, point resistance to assist us a little bit. And you might say, 22% is a pretty big move, and I'm actually a little bit worried about it maybe going up to 80 and potentially down below 40. So we know at a 65.44 we can get 281, but let's just play with the numbers for a second. Let's see what we could do if we set 80 on the call side and 40 on the put side. It's an 84-cent credit, which now, since it's a wider strangle, only requires 670 of collateral. So what we can see right here is you would get 84 of profit divided by 670 of collateral, and that's a 12.5% return on collateral. So relatively half the return, but your upside is now protected up to here and your downside's protected down to here, and that's before adding on that 80 cents of cushion. So it's really all about, I guess, most of trading, right? It's all about the risk to reward profile that you want to take on. I'm partial to the 80-40 spread because I'm a little bit scared of the upside and it jumping back and filling the gap that this candle formed, which we would be in a loss position at our original. But I love the fact that the 80 corresponds with this peak, this valley right here, so to speak, from back in January and then up in March. So I think over the next week, you'd be hard-pressed seeing it run through 80. However, on the downside, I'm okay getting a little bit more aggressive because there's a little bit more, I guess, visible support here, as we could see as it was trading right around this 40 level through the first couple weeks of May. And it traded around this area for a little bit of time between October and December of last year. So again, that's a strike I'm happy being at. Now with plays like this, I do want to caution, since their earnings are on, when are their earnings? No, their earnings are Monday. So this is a perfectly good time to do that. I do like to open these right before close so we know exactly where the stock is. So I'll probably wait until 3:30, 3:45, 3:50 just to confirm that it's still at this price level. But I really like the 40.80, and I'm going to throw that there on my if I could find it. There we go, my profit tracker. So for earnings, SFIX 40/80 strangle, and we know what that strangle means. We sell the 40 put, we sell the 80 call, and we're getting right before 10 o'clock. So I'm gonna have to wrap this up right now and hop off. We could talk a little bit more about some future trade ideas and more earnings related plays, but hopefully that gave you guys a decent general idea. We love Zillow this week. Biogen is a super interesting one with a great value proposition that we dove into a little bit. And then on the earnings side of things, I think that Stitch Fix 40/80 strangle is one where you're able to, again, take advantage of that concept of implied moves during the week, take advantage of the volatility that earnings provides you with to set yourself up with a really high probability play that still provides a really nice weekly return from a return on capital perspective. So with that, thank you guys for tuning in again. I appreciate you guys who are back watching us in the chat week after week and interacting. We always love seeing you guys checking in. Always happy to answer any questions that come through, but we are going to sign off now. If you have any other questions, feel free to throw them in the Discord server, and I will 100% get to them. But on the stream, we're going to have to cut it off right now, so we will sign off how we do with most of our videos, saying thank you for watching. This has been the Hourglass Trader, where as time passes, we make money. Thank you guys, and we will see you again, hopefully,